Good evening, everyone, and welcome to all of you in this September series of webinars. My name is Yogesh. Everything I'm going to discuss over here, it's for information purposes only. If you want to implement any strategy in your live accounts, please talk to your risk experts first. Please talk to your investment consultants or talk to us first before you implement it. And today we are going to do a touch base on a very different topic. What happens when a real estate market is coming down? I'm sure what you do with real estate is what you do with stocks also. Because when real estate market, when it starts coming down, you cannot wait wait till it comes at the bottom. There were two kinds of investors in the pandemic. One who invested in real estate, one who thought that it's going to come down more. Now, those who did, you know where they are. Those who did not, you know where they are. So it's all about taking that chance. It's all about taking that risk. We have to understand that risk prevails everywhere. Even when the markets are down, do not think about uh, getting out. If you have your retirement funds, you continue to put money into those funds, because if new trades are being placed, the stocks which were higher right now, which were higher before, are available to you at a lower price. So even during a downside market in volatility, please continue to add on to your retirement funds as well. Right. Second is stay invested. Stay invested is, it's a very important thing to stay invested, because successful market timing is very difficult. What is successful market timing? It means that you trying to time the market, that this is the exact time from where it is going to bounce back, or this is the exact time from where it's going to come down. You can't do it. It's very difficult. Getting out at the right time, getting back in the right time, you can't do it. Nobody can do it. So that is why you need to avoid jumping in and out of the market. Need to stay invested. That is also one of the most important things when the markets are volatile. I will show you something probably that should help you understand this. Look at this particular thing right now. Just have a look at it. Right now, if you see what the chart is trying to show you, and ask me, guys, again, if you have any questions, please go ahead and use your Q&A options to ask me. If you have any kinds of questions and queries, please use your chat options to ask. Now, what you see right now, this, what does it show? This basically shows that market is much calmer in the long run. So the chart which you are seeing right now, the span which you see, it's between the largest average 1 year, 5 year, 10 year, 20 year gains and losses. And we are looking at like three very important stock markets. So there are stock market indices, the stock market index is there. There are government bonds and treasury bills, right? Treasury bills are basically the short term US government bonds, and the middle one is the long term government bonds. Now, 1 year, 5 year, 10 year, 20 year gain. So, as you can see from the shade, the white bar is the 1 year holding period, the black is 5 year holding period, the lightest gray is 20 year, and the mid gray is 10 year holding period. Now, when you see this particular chart, this is between 1926 to 2009, and these are the key market indices. Now, if you see short term holdings, especially in stocks, look at the volatility. The 1 year volatility, look at it, how much it is. Like a long term approach has provided a very smoother ride, right? But if you see extreme volatility, a 1 year holding period, from minus 67.6 to 162.9% return. But if you see on a 20-year holding period, see how calm it has become. 1.9, between 1.9 to 18.3%. Same for government bonds, same for treasury bills. So what we are trying to tell you is that over a longer period of time, eventually what happens? Eventually, over a longer period of time, the market, if you see, it smoothens up the volatile process. So you need to Stay invested. I'll show you one more thing, and that is going to change your perspective about how you see markets at all. Look at this particular return, right? You see the market cycle. This is the growth of, so if $10,000, which was a big amount in 1950s, by the way, if $10,000 was invested in 1950 and in S&P 500 index, by the way, by 2023, the value of that $10,000 would be 30 million. But obviously, $10,000 in 1950 was a bigger amount. But you see, from 1950 till 2023, the orange bars which you see, these are the bearish markets, right? So 1980, 1975 or 72, then look at 2001 and 2008, how many bearish markets have come. Then you look at 2008, for example, 2020 pandemic fall, look at this. There have been so many bearish markets also, right? So bulls have passed, bears have passed. But still, if you see your return is positive, why? Because over a longer period of time, this smoothens up. And the most important part, now this is where it becomes more important. This is what I wanted to show you. Because we have talked about it in times of volatility, the market seems, it may seem very tempting, right? Obviously, timing the market is very impossible, right? Can be a very costly mistake also. So the chart which I was showing you previously, now if you see this, like it's a historical perspective, right? How a pattern of bull and bear markets, it's very tempting to investors. Why not try to time the market, right? But the point is, wouldn't this be more lucrative at this point of time if you just buy and hold? So it's not easy to short sell when at the orange and buy at the blue, because that would be a very costly mistake. Now, if you see this, the second chart, this is where it becomes even more interesting. If today you as a trader or as an investor, if you try to avoid the time when markets are going down, you might be missing out on the ups as well. So you're trying to avoid the downs, but you might be missing out on the ups. Why? Because this chart, what you see right now, it shows you that 78% of the stock market's best days, they have occurred during a bear market, mostly during the bear market or the first 2 months of the bull market. So imagine, look at the second graph right here. The growth of $10,000 between 1994 to 2023, had you invested in S&P 500 index, right? If you, from 1994 till 2023, if you were fully invested with $10,000, you did not take it out, or you did not, when the markets are going down, you were not out of the market, you were fully invested. That $10,000 would grow up to 181,000. But look at this, if you miss out on the market's 10 best days over the last 30 years, your returns would have been cut in half. Instead of 181, you would be down 83,000. If you miss out the best 30 days, your returns would be down by 83%. Look at this graph, guys. This is the most interesting lesson in the investments, that if you miss out on the best trade, and you don't know what are the best trading days, right? So that's why you need to be fully invested and all days, because the best trading days, 78% of the stock market's best trading days occur during a bear market only. The same bear market where you are scared about, where you most of the time say, no, I don't want to invest right now because markets are down. 83% returns would be compromised if you miss out on the 30 best days in last 30 years. But if you are fully invested, you will see how much money you would have made, right? So this is an important lesson, guys. Please remember this thing, that if you are looking at that the markets are falling down and there is a lot of volatility, it is an opportunity. I'll, even if I show you some live charts of the commodities like gold or oil, you will see how much they have moved back. Last 3 months, gold prices have moved more than 15% very easily. It's already breaking a new high. It has reached to 2500. I'm sure everybody's aware where gold is reaching to. Even US stock market index, after falling so much again, it has started recovering. So the when especially when the markets are going down, you need to stay invested. This is what it means. And then comes the part you should always diversify, is what I always believe, and I always say that you should never put all your eggs in one basket. You should definitely diversify into different products. I'm going to show you some strategies also, which over a period of time we have discussed back in the few sessions. But once to put all of them together, you will get an idea that how these kind of strategies work, and what you need to do to actually invest. And it's not that difficult also, right? These are different products which we see. But when you say always diversify, for example, so let's say for example here I'll open a diversified. So last time we were talking about ETF portfolios, right? Let me show you a diversified ETF portfolio. It's an old portfolio, but look at the way how you can diversify into different ETFs. Let me show you. So first one, as we all know, the SPDR S&P 500, largest. And guys, if you have any questions, please ask. And if you want to note down, these are very important funds. If you ever want to note it down for your own research, you can. Look at SPD or S&P 500. So this is the world's largest, most heavily traded ETF, right? Gives you a exposure on the large cap equities and S&P 500. So all the 500. So basically, this particular fund represents all the 500 stocks which are there in the S&P 500, right? And these are large companies. Again, very impressive growth rate, 5.35% dividend growth, and all of that. Now move on. We discussed about Invesco Triple Q in the last ETF series when we were talking about that, which are the good ETFs. So Invesco series, it comprises of the fund that tracks the performance of Nasdaq, right? So this is mostly exposure to tech. So one is S&P 500, one is the Nasdaq, which gives you a tech exposure. Now there is one more, which is MSCI Emerging Market ex China ETF, right? So this is basically a emerging market fund, but it excludes Chinese market. This was introduced at the time when Chinese markets were not performing really well. So investors would like to take investments in emerging market, but not the ones which had China in it, because China was not performing really well. So there were traders which wanted to not invest in China, but still wanted to take advantage of the emerging markets, and a lot of people would invest. So now you see how you are diversifying. You are invested into a large cap US based equity fund, then there is a US based tech stocks fund, and then there are these emerging markets which excludes China. Now this was before, but now obviously since China is growing, you can always invest into some Chinese funds as well. And then there is an index which is called Euro Stocks. Now, it's mostly a ETF which represents the capitalization of 50 leading blue chip companies in the Eurozone, right? So you talk about Louis Vuitton, you talk about Hennessy or SAP or ASML Holdings. Most of the industry sectors were European banks, then apparels, then semiconductors, oil, and most of the geographical allocation was in France, and then Germany, Netherlands, Spain, Finland, Belgium, all of these particular. So this was something which was, again, you could take a separate diversification in Eurozone. This all I am telling you that how you can diversify. Now so far you have invested into different geographications. You have invested diversified into different markets. Now imagine an ETF where you can diversify with the common attribute, like the companies which gives you good dividends, select dividend fund, right? This basically gives you exposure in those stocks which are known for giving you consistent dividend payouts. So there is a dividend fund you could invest in, And imagine this one belongs to the BlackRock, which is one of the highest AUM. So you could also now, which were the companies in this? Altria, Verizon, IBM, AT&T, Seagate Technology, Philip Morris, all of these kind of companies which have a history of giving good dividend payouts. So now you're invested into emerging markets, you're investing into US markets, Eurozone funds. Now you're also invested into Dividend Select, the companies which gives you good dividends. Then there was ARK Innovation ETF back then, which would allow you to basically invest into the companies which were bringing a innovative or a disruptive technology. Right, we talked about investing in change. So instead of putting only into investments only into fintech or only into robotics or only into DNA sequencing, you could invest into a arc based fund which would give exposure to all these areas, right? So you could do that. Imagine at what level this diversification is going on. Then again, small cap funds where the smaller market value companies you can invest in. Then followed by consumer staples sector. Consumer staples, which basically is a sector which consists of retail, cosmetics, beverages, food and agriculture, which are the companies Procter and Gamble, Costco, Walmart, Pepsi, Coke, Colgate, Target, all these kind of companies. So you see how you are diversifying. You started from the country, you moved on to the theme, you moved on to the sector, then innovation, then emerging markets, and then you are now moving on to a sector which is mostly known as a recession-proof sector. Because even during the recession, you do whatever not, but you will still continue with your basic necessity, which is consumer staples, right? So this is how you are diversifying. Then you followed by SPDR gold based funds, right? You can, if you want an exposure in gold. Then there are bond based funds, investment grade corporate bonds which you can invest into. So a lot of way a diversification can happen using stock funds, bond funds. Within stock funds you can do emerging markets, you can do so many other instruments, and you can diversify. Even commodity based funds you can diversify. So diversification, guys, it's really important, and we should always try to achieve maximum diversification as much as we can, right? So here, how we are trying to proceed further after we have diversified, we should also make sure that we should not forget history, right? Never forget the history, because we should always remember historical worst is not the real worst. Whatever you have known so far, whatever you have observed so far, it does not mean that this is the only thing which has happened, and things are not capable of getting worse. History repeats itself, and every time there could be a new history which can be formed. So we have to always remember that, see, worst of the times we always forget the market declines, even the ones which have happened. But it's a natural part of the economic cycle, and a decline can always happen. And sometimes the new stock market crash could be much higher than the previous. That is why the diversification is really important. I meet a lot of clients, and sometimes they are very focused on one specific market or one specific sector or one specific investment. That is not the right approach, right? Next is, obviously you should speak to your financial professional. Don't make really quick moves based on emotions without you speak to a investment professional. A investment consultant is also like a doctor. You may not want it, but you definitely need one. You are busy with your own job, you are already taking care of so many things. Even if you're an avid reader, if you're an avid researcher, you still need a second opinion. That is why you require a consultant. It's not something which shows that you are weak. It basically shows that you are brave enough to take another opinion. You are brave enough to take other view and then decide that where to invest. So consultants can always help you analyze your investment goals, for how long you want to invest, what's your risk tolerance like, what are your financial circumstances, and how do you need to allocate your investments. There are so many strategies which a lot of investors, they don't know because they don't have the time, because they are already busy with their own job. So you need to have an investment consultant. Obviously there is a cost attached to it, but then your money is precious. Whatever line of investments you get into, but you have to understand that whether risky or not, when the market drops or goes up, your investment goals also change. As your age progresses, your investment goals change. As your income changes, your investment goals change. So you need to be aware of that. As we were saying that, see how missing the market's best days. If you miss out on the 10 best days of the market, you lose on 54% of the returns. You miss out on 30 best days. Imagine in 30 years, you missed out on only 30 best days of trading and your returns would be down by 83%. Imagine that. That is the power of being fully invested across. So guys, understand the maximum the and 78% of the best trading days were during a bear market and during the first 2 months of a bull market. Obviously, you would never know what are the first 2 months of the bull market, but you know that during what is a bear market, right? When markets are constantly falling down. So you need to throw away that scare that, oh, I'm going to lose money in a bear market. No, it could be a good buying opportunity also. Let's understand some of the strategies which can be done, right? Because obviously, at the end of the day, there are so many strategies which people do. There are so many events which happen. During those events, there are times where you can try to implement a strategy also, and that strategy can work. I mean, that is something which can happen. See, one of those strategies is called uh, price action analysis, the one which you are think the third part. There are market neutral strategies, there is seasonality analysis, there are investing in Euro Buxel, fixed coupon bonds, SIP portfolios. I'm just going to go one by one, and if you have any questions, please continue to ask. Uh, okay, let's start with seasonality instead. From the very first. So let's understand what seasonality analysis basically is. And it's exactly as the name suggests, how seasonality analysis work. And I'm going to show you something really interesting so you can understand that how seasonality analysis can also work. And uh, again, you will realize that it's not any rocket science, and this is something which you can also uh, could have found out on your own, but since now we are talking about it, so let's understand that how each of these strategies work. Seasonality analysis, if you're looking about a stock or agricultural commodity or any of the financial instruments, what do you know about seasonality, how it works? There are So what you do is, in a case of seasonality, you go back in the past of that particular product and track uh, their returns month on month over a period of years. So what you do is you see month on month that how that particular product has performed: January, February, March, April, May, June, July, August till December. And then month on month, and you see then over a period of years that which month has been more favorable, and then you try to find out the fundamental or the technical reason that why this month has been more favorable. Let me share something really interesting with you. Look at this. This is a seasonality pattern which was made a year ago on cotton. All right. Now, the fundamental reason was that December, most of the time, it has been observed that cotton prices they turn positive. Reason is that 65% of the world's cotton comes from US, India, and China, and cotton is grown mostly in warm and humid climates. December is the winter season in US, even in India also. And again, across the US, the weather is blowing dry, cold, stressing crops and harvest. So the supply is not that great in December, and that is why the cotton prices tends to go higher. In India, if you see export demand from neighboring countries and winter season demand in the domestic market is increased usually November, December. Now that helps cotton prices to trade on a positive note. This is a fundamental. How do I prove the technical? Look at this. This is a seasonality chart. The red ones are the ones where the cotton prices ended negative. Green is the positive. And the first column from your left is January, then February, then March, April, May, June, July, August, September, October, November, December. And the horizontal columns, or the rows as we see, the horizontal rows are the years. So starting from the lowest 2002, sorry, 2003, 2004, 2005, and then the topmost to 2023, right? Now, if you see all these months, where do you see the maximum green? Can anybody answer this? I think everybody can see this. Where do you see the majority of the greens in this? Use your chat options, guys. I think that is how we can make this a little more interesting if you also participate. Where do you see the most greens, the majority of the greens? I mean, there is no month where it has been completely green, but where do you see majority of the greens and less of the red? All right. I think everybody has seen the same month. It's December, right? I think everybody can see how crystal clear it is. Now, I'm telling you what you see right now for December. This is last 20 years, which means in last 20 years, this shows that mostly the prices they end positive in the month of December. Out of 20 years, 16 times it has ended positive, 4 times it has ended negative. Now that gives us a good probability that next time, if I see cotton prices falling around in November, I want to buy it and hold on to it till December, because most of the time we have observed that in December the prices go positive. That is the idea of seasonality analysis, right? So when markets are volatile, you need to diversify, you need to find out different strategies, guys. I mean, you these days the markets are so unpredictable, things are changing as we speak. So how can we be fixed on just one idea or one strategy? We have to spread our investments across. Today, I will never tell you to take all your money out from real estate and put it into bonds, or take all money out from bonds and put it into stocks, or take all money out from stocks, put into trading. Never. You need a mix of all of this. And similarly, seasonality strategy is one of those understandings where you can do. Now, you can do this in cotton, you can do this in rice, you can do this in sugar, you can do this in wheat, you can do this in soybean. Sometimes you can do this in an index also, like in S&P 500. If you do the seasonality, you can try to find out that which are the most important months where most of the time S&P has shown positive strength. So we have our consultants who do a lot of seasonality analysis, and we bring these numbers and data to the clients and investors, and we tell them that, see, this is one way you can diversify. This is the power and this is the significance of having a consultant by your side. This is not some statistics which is available on Google right away. You have to sit at Bloomberg and find it out. Have to pay for, like, the consultants, they work on these terminals which are paid terminals by the company, and obviously that cost is never passed on to the end user or the end consumer. So we try to bring these strategies to you, and again, that is where the consultant plays an important role. Now, that being said, next is a market neutral strategy. A market neutral strategy, we have always um, th- talked about market neutrality in a perspective where we feel that how we can take advantage uh, of prices going up and down, right? So the most easiest way and the most important way how you can take advantage of a market neutrality is, because in the derivatives accounts you can take a position when you're on the buy side. You can also take a trade if you're expecting that the prices will come down. You can short sell it. We've discussed short selling back in the past, so just to give those people an idea who are not aware about short selling, short selling is the process by which you can borrow the product which you feel the price of which is going to come down. You can borrow that product from a buyer, or from the broker's inventory, and you can sell it in the market. And once the price drops, you buy it back at a cheaper price and keep the price difference with you and give commodity back to the broker or to the buyer. That way, you made money from the falling markets. To understand more about short selling and how it is done, I can always have a one-on-one session with you and I can explain it to you how it's done. But market neutral strategies are based on this idea where the product which you feel is going to go up, you buy. The product which you feel is going to come down, you short sell. But you do it in a manner where between the products which are very close to each other in some manner or have some sort of relationship. So I'll discuss two pairs with you. One is a very recent pair trading strategy, which let me share it with you right away. Um, this was between Hong Kong and Japan, where we talked about that how you can buy Hong Kong and short sell Japan. And the idea is very simple. If you divide the price of Hong Kong by Japan, the ratio which comes on a chart, this is where the ratio is, which means the ratio of the prices of a Hong Kong index and Japan index was at its lowest. Now, for this ratio to grow, Hong Kong, which is the numerator, the prices need to increase, or Japan, which was the denominator, the prices need to come down. So, on a technical perspective, we realized that this, if I were to look at a 30-year chart of a price ratios of Hong Kong and Japan, this is the lowest it is. Again, what is the ratio? Ratio is the dividing the two prices of two instruments. In this case, the Hong Kong market versus Japan market. So when you see this, you will see that on the 30-year chart, this ratio has come down and touched the lowest. Now, obviously, a technical reason is not enough to just enter into a trade. So what we see fundamentals. Why China is good to buy. Post-COVID recovery slightly has been sluggish, limited signs of improvement. Manufacturing is still weak, right? Property market slump still hindering the growth. But economic weakness has already been reflected in the market. Stock markets already crashed back in 2022 for Hong Kong. Now, to stimulate the economy, a lot of economists they have called for more aggressive government action. The Central Bank of China could lower interest rates down further, could increase more cash, inject more cash in the economy. Government need to increase the budget deficit, right? Uh, Again, Chinese lenders may lower the 5 years, so even the long-term loan rates could also come down, right? Alibaba has secured shareholder approval to upgrade its Hong Kong listing to primary status. A lot of analysts have anticipated that this is something which is again going to bring a lot of investment from mainland China, billions of dollars. So all of this was the reason why we would expected Hong Kong to move higher, right? Now, if you see how the moving average again is it's more of a technical, but let's stick to the fundamental here and we can discuss more on the technical part later. Looking at the Japanese part, again, Japan economy and stock market heavily reliant on export. Japan has increased the interest rates recently, so that was the reason why we saw markets falling down because a lot of investors they were selling their assets in yen because the interest rates were high, so their investments were making a loss. More interest rate increases could strengthen the yen. Now, Japan relies on exports, so a stronger yen is going to be very less competitive when it comes to Japanese goods as compared to the global market. So that negatively impacts the profitability of the lot of export-oriented companies. There have been a lot of political scandals in Japan also, especially on Japan's Prime Minister Fumio Kishida. So he's going to step down in September 2024. So there will be a lot of challenging tasks coming. Inflationary pressures in Japan, they have started increasing in 2024, which has not happened before. So again, there was a fundamental reason why we want to short sell Japan. There was a technical reason why we would buy Hong Kong and short sell Japan. So that was the idea to create a pair. So idea was that you buy Hong Kong, short sell Japan, both the indices, and if the world stock markets moved up or down, or Asian stock markets moved up or down, you would buy on Hong Kong, short sell on Japan. So you would be able to reach market neutrality when it comes to Asian markets, right? Now you're not worried about the entire Asian market. You are more worried about that between Hong Kong and Japan. If the Asian markets fall, you just hope that Japan falls more than Hong Kong. So you make money in your short selling trade and make less loss in your Hong Kong. If the Asian markets go up, you expect that Hong Kong moves more higher than Japan. So your loss in short selling in Japan is less as compared to profit in Hong Kong. This is called market neutrality. This is called investing into market neutral strategies, or also called pair trading strategies, right? So these are ways how you can achieve market neutrality. Even in commodities, there are two kinds of oil, Brent and WTI. The price difference between Brent and WTI is always moving. Like currently, if it is $3, it used to be 10 also, it used to be 1 also. So what you can do is, because oil prices move in similar directions, even percentage increase or decrease is mostly the same. Sometimes when you see the price difference between two oils is less, you buy one which is expensive and you short sell which is the one which is cheaper, expecting that the one which is expensive will go higher, the one which is cheaper will go lower, and the price difference will increase, and that is how you make money on that particular pair. So we have done a separate session on market neutral strategy. It's a very vast curriculum, but there are so many strategies in this. And as I said, that is why you require a consultant, so that we can explain it to you that how these strategies work. Again, it's not uh, very easy, but it is simple. That's the thing. Investments are never easy, but they are very simple. We complicate it. When I say we means we as people complicate it, but it's not really that difficult. There are a lot of these strategies which can be explained to you in a very simple manner. A lot of times fund managers, they use terminologies which are not uh, favorable to your understanding, but here at Century Financial will sit with you and will make you understand the most easiest way. Obviously, as per the current time constraint, I have to cover more strategies, so I'm giving you an overview of what you can do and how you can do this. We talked about seasonality, I gave you an example. Talk about market neutrality, I gave you two examples. Now there are more strategies. Let's talk about price action analysis. Now, price action analysis is something which very few of you would have heard, but a lot of you know that earnings come out. When earnings come out, stock moves. If the earnings are really good of a stock, then stock moves up. If the earnings are not good, stock moves down. And the earnings which they come after the market closes or before the market opens. So there is no way that you can trade in a stock and the earnings comes out that moment and you make money or lose money over there. You have to take a decision that if you expect that the price of the stock, if you expect the earning of the stock is going to be positive by the end of the day, you can buy the stock. If you feel the earning per share and the revenue is going to be a miss, you can short sell a stock. Now, price action analysis allows you to actually go through the previous price movements after the earnings have declared. So, for example, today is 16th or September, let's say 18th. On 18th September, a stock named General Mills will come up with their earnings report. Their last price was $73. The Bloomberg target price is 69. Earnings will come before market. Now, probability of a up move, like probability that this stock will move higher after the earnings, is 56%, and this is based on last 10 years of data on the similar quarter. One day move after earnings expected is 3.1%. Average move on the day of earnings, if you hold the stock on the day and close the stock by the end of the earnings and by the end of the day, you could make 0.7% up or down the movement. Historical gain has been upside 1.7. Historical loss maximum has been 0.9%. If you hold the stock for a week during the earnings, historical gain was around 8.3, historical loss 3.9. If you hold the stock for a month, your gain could be historical 5 or historical loss 7%. Price action analysis tells you how much a stock can move after the earnings come, how much historically on a positive side it has moved, how much historically on a negative side it has moved. What is the probability of beating the earnings? What is the probability if you hold the stock for a week or for a month during the earnings? So this is a very important data which again you do not find it on Google. This is not something which is available right away. We find out this data and we present you a strategy that, see, if earnings are coming out and markets are volatile, don't take a chance. Just see the stock which has the highest probability. And if you're speculating, speculate with numbers. You go out on a battlefield, you need enough research and data to understand what's your strength, what's your weakness. There will never be a guaranteed result that you are always going to make a profit or not. But you need to be well informed. My question is, are charts or technicals enough to place a trade? You need to know that how much volatility, how much fluctuations has this particular stock occurred in last 1 month or last 5 days or 10 days or 10 years. And this is what price action analysis tells you. So the strategy is very simple. All you need to do is look at the stocks, see when their earnings are coming out, and then see that out of these stocks, which companies have a probability of beating the earnings the most. And then see their average fluctuations, that if I buy the stock today before the earnings come out, and if I close it after the earning comes and after the market closes, if I sell the stock last 10 years, what is the record if somebody has done this? How much it has moved if somebody bought the stock on the day of earnings and sold it by the end of the day? If somebody bought the stock on the day of earnings and held on to it for a week, what was the average volatility? How much did it move? Have you checked this ever? No, because normally what we do, oh, okay, this stock is coming up with the earnings. Most likely it's going to be positive. Let's buy and see where it goes. You are not aware about the numbers at all. That is what is important. When you are trading in a volatile market, you need different strategies by your side. You need a seasonality or a market neutral or price action. And this is apart from the investments, what you do. What you are doing is very good, but I'm giving you more tools to look at. Right. Similarly, then there is investing in Eurobuxel, fixed coupon bonds, as we all know, bonds which gives us fixed interest. You can always buy and hold. That is a part of your portfolio. SIP portfolio. SIP portfolio. Uh, this is again a very important. The last section of this. Never stop your SIPs in, even if the market is volatile or even if it is going down. Please do not stop your systematic investment plans. A systematic investment plan or a SIP is an investment plan in which investors, they make regular equal payments into a fund or a trading account, and they buy every month on a specific date with a specific amount they buy. But a lot of times people make this mistake that when markets are coming down, they stop putting money in those accounts. Never do that. In fact, continue to make SIP. In fact, buy more when the markets are falling down, especially when we are talking about stocks. There are a lot of SIPs portfolios. I'll share one with you right now. There are ETFs where you can invest into an SIP and check. This is going to be the um, last strategy, but just have a look at this. Look at this SIP portfolio and see the ETFs which we have discussed back in the past. You can do SIPs in all these funds: India based ETFs, bond based funds, gold based funds, S&P 500 based funds, NASDAQ based funds, and even a minimum of 500 to $1,000 can be diversified between this. So if you can put $1,000 monthly or $500 monthly or $100 monthly, it's up to you how you want to do it. But the diversification can be done. Even so, I'm giving an example of $1,000. $200 can be put monthly into these ETFs. One gives you an exposure to tech, one gives you an exposure to large cap 500 companies in US, one gives you 50 based Indian companies, one gives you gold based investments, One gives you large long-term bonds, iShares 20-year bonds, US government bond space. So from bonds to commodities to emerging markets to developed markets to tech, you can make an SIP out of these things, right? So this is something which I wanted to share with you today, guys. Investing in volatile markets, it's not a rocket science, but you need a box of different strategies. While you are doing SIPs, earnings are coming out also. So SIPs is different. Earnings are coming out, use price action analysis. Only trade. So you know that volatility is going on. A lot of short-term traders, they will rely only on price action. They will see last 10 years, okay, this particular stock has a probability of beating the earning estimates in last 10 years for this particular quarter. If people bought the stock and held on to it for a week, the average volatility, the average movement was this much, maximum gain was this much, maximum loss was this much. So you need these kind of numbers also, so you can take better investment decisions. All right. Market neutral strategies. You need to trade in pairs: gold, silver, Brent, WTI, Hong Kong, Japan. So what happens is the impact gets neutralized. The overall market impact gets neutralized. If you buy Brent oil, short sell WTI crude oil, it does not matter where the energy market goes. You are speculating on the price differences between Brent and WTI. So that is also something can be done. Seasonality can be done on agricultural commodities, a lot of them. Can be done on indices also, just to see that what is the record of which have been the record years where this particular product has performed well. If there are more greens in December, why not invest in this product during December? Gives you an idea, right? You can invest in fixed coupon bonds, which gives you a fixed coupon. And you can invest in Euro Buxel now when ECB has reduced interest rates. So the prices of the bonds might go higher. So invest in long-term Euro bonds. Make a mix out of everything. And this is apart from your day trades, by the way. I have not even talked about day trades where you invest for put your stop losses and everything. So that is something which we have not even talked about. That is something which is on you. So there's a question here. Please, can you discuss more for investment long, short term, but will holding cost be more on smaller investment? See, this is the important questions again. If I've understood it correctly, see, long term investments, if you're doing ETFs and if you are buying stocks, prefer do it in a non leveraged account because holding cost will be higher. So, anyways, if you're doing anything for a longer term, no need of paying a holding cost. As far as the short term trades, when you do short term trades, if you hold on to it for entire day, close the trade before 1 a.m., you will not be charged any holding cost. As far as the pair trades are concerned, because I'm assuming that even that could be your question. So as far as pair trades are concerned, where you buy one and short sell another, most of the time, sometimes it happens that we see a few pairs like Brent and WTI. Sometimes Brent and WTI is so much in a favor that if you buy Brent, you will pay say 8%. But if you short sell WTI, you might receive 10. So net net sometimes on pairs you receive holding cost also, right? And that is why you could work with pairs, but that is not always favorable. Sometimes it is, sometimes it not. But trading in pairs might also reduce down the impact of the holding cost. That is also possible. Uh, will holding cost be more on small investments? Not necessarily. When you say small, does it mean the size of the investment or the duration of the investment? Short term investments, yes, there will be holding cost, because if you, it depends basically that for how long you are holding on to it. Because if you're talking about short term, if you open a trade today and you close it today, there will be no holding cost. If you open a trade today and hold on to it for 1 or 2 days, there will be a holding cost for 2 days. But if you buy something long term and hold on to it, obviously holding cost in that particular product will be higher. But that's why I'm saying that if you buy something for a longer term, a stock or a ETF, you must do it in a non-leveraged account. Holding cost is charged because you do this in a leveraged account. You use margin for it. So that is why you are charged holding cost. But if you do it in a non-leveraged, in a cash equity account, which we also provided to you, you can not, you don't have to pay any holding cost. So this is a right way to do it. Even in your SIPs, you don't have to pay holding cost in SIPs. You can just buy whichever ETF you want in a non-leveraged way. Don't take the leverage, and you don't have to pay holding cost. In short-term trades, the holding cost will be less as compared to long-term. But then for long-term, you never need to pay the holding cost, because for long-term trades, you should not trade into a leveraged account. Not now. Right now rates are still high. Maybe in the next 2 years, when the central bank reduces down the interest rates, then you can again do these investments in leveraged accounts, because leverage has its own advantage, right? If you take 2 or 3 times leverage, your returns are also magnified, your risk is also magnified, but your returns are also magnified. So it is an advantage if you do it in a leveraged account. But right now, because interest rates are too high, it does not make sense to take long term trades, because even if you take a leverage, you're increasing your risk plus you're increasing your cost. Maybe in the next 2 years, when interest rates come down, maybe that's the time you take advantage of the leverage. So definitely, please definitely discuss this with your consultant also, and we'll definitely give you the right way to do it. Right. So once again, guys, thank you so much. If you like this session, please go on Google Century Financial, Google reviews. Please let us know how can we do better, or please do share your feedback on Google reviews and Century Financial. It really helps us and keep us motivated to do more sessions. As I've said, that this month of September, I've done every working day, every trading day, I have done one session for our attendees. We started with then financial literacy. We moved on to investor psychology. We talked about fundamental analysis, technical analysis, understanding economic data. We talked about ETFs. We talked about market neutral strategies. Today we talked about investing in volatile markets. Tomorrow we are going to talk about different ideas, and as and when the session progresses, we are going to do a lot of touch base on earnings season. We are going to discuss this price action analysis and earnings separately in a session coming next. Go to century.ae under webinars and look at our full calendar. We are doing a webinar literally every day of trading, and we'll have one session on US elections. We are going to have a session on FOMC statement, and a lot more is coming next. So just stay with us, be connected with us, and we are more than happy and proud to bring you all this information. And we just want you to attend the session, and that is something which we really want to proceed further. I've met you before, but can we discuss how can I do better in trading forex? Why not? Why not? See, short-term trades are speculative trades, but it's always good to keep refreshing more and more. And the best way to uh, even understand trading is to be involved and do it every day, at least in a demo account, to get familiar with how an instrument moves. A lot of times we don't know the average movement. Like gold, I am telling you, gold moves at least $30 a day. So now you know that how much profit you can expect or how much loss you can expect from gold, at least if everything is normal. This is how much a product can move. So we need to understand how, if we study volatility enough. I mean, one thing I have not discussed here, which is called volatility index. You can actually buy a volatility index in your portfolio, and that is something which goes um, if S&P 500 drops, the volatility index moves, and that is something which has been observed. So if you're buy on stocks, if you're long on stocks, and you feel markets are going to come down, you can actually buy a volatility index to hedge your portfolio also, and that is also something which is available in the form of a exchange traded fund or a exchange traded note. So that is also something which you can do on a leveraged account, right? So we are going to come up with all of these ideas, guys. Definitely, this is something which we want to discuss further. And thank you so much for joining this session. We are going to meet you tomorrow again, the same time, with a different topic. And let's continue and continue and foster an environment of learning. I'm really proud of what we are achieving over here. So let's continue to learn more, and let's continue to progress further. So till then, um, we'll meet you once again tomorrow. And thank you so much for your time. And my name is Yogesh. We'll see you once again. Have a great night. Have a good night.